This meeting is being recorded.
Welcome and thank you everyone for joining us today for the HHC Capital Corporation Semi-Annual Board Meeting. Today's meeting is officially called to order. Please note for the record, Erin Kelly is representing Deputy Mayor Ann Williams Isom in a voting capacity, and Dr. Michelle Allen is representing Dr. Katz in a voting capacity.
Also, Karen Simpel is representing Jerry
And Karen Hilaire. Sorry, thank you. Is representing Commissioner Carrie Jenkins in a voting capacity. So next on the agenda is the adoption of the minutes of the HHC Capital Corporation meeting held on January 27th, 2022. Are there any questions, comments, or suggested changes? Hearing none, may I have a motion to adopt the minutes?
So moved.
A second?
Second.
Okay, great. And all those in favor?
Aye.
Any opposed? Any abstaining? And the motion is carried. Next, I will turn the agenda over to Linda DeHart and Pauline Locke to provide an update. Linda?
Thank you. So just a note of reminder on these meetings, the Capital Corporation exists sort of effectively as a holding company that receives our pledged healthcare revenues and holds them to cover debt service before they're released to the corporation for operations. So we don't generally have business for the subsidiary to carry out, but we use this opportunity to provide an update on our debt finance program. We have historically it's required that we have at least 2 meetings annually. We've historically done them in January and July, providing 6-month updates. We've gotten off of that schedule for some time now, but we're going to attempt to get back on it after this meeting. So we will be presenting here a year-end report through June 30th of 2022, and then we will meet again in January with the 6-month report. And we intend also for that meeting to do a deeper dive on some cash flow issues around the capital program. So on the first page, we just have a snapshot of our existing bond portfolio. We have outstanding bonds of $472 million, 124 million, or roughly 26%, is in variable rate bonds. The balance of 348 million being in fixed rate bonds, all tax exempt. Our variable bonds continue to be supported by letters of credit from TD Bank and JP Morgan. The TD Bank letter of credit expires in September of next year. And once we sort of cross that threshold of being within a year of expiration, we begin to work on renewal or replacement. TD has agreed to provide an extension, which would run through September 2027, and we are currently working on documentation for that extension. The JP Morgan letter of credit runs through February of 2026, which coincides with the maturity of those bonds. On the next page, we provide just a picture of the history of interest rates to give some context to our variable rate performance over time. We estimate that since the inception of these 2008 B through E bonds through June of this year, we have saved $72.3 million by having done these as variable rate bonds as opposed to fixed at the time they were issued. The last reset for this report through June was ranged from 0.86% to 0.88%. And I'm sure board members are aware of the recent changes in interest rates, and we will discuss that briefly at the end of this report, as well as reflected in our 6-month update provided in January. On the next page, we provide a history of our bond issuance. You can see again that we currently have outstanding bonds of $471.9 million, nearly 2/3 of that being from our last issuance in 2020. That $310 million issuance included $210 million roughly to refinance prior issuances and about $100 million of new money for new projects. On the next page, we give you the status of the construction fund from that new money at just over $100 million. We have to date drawn down just over $26 million, leaving a balance of 24, including interest earnings. We had hoped to have this expended more quickly than what we are experiencing. It's heavily been influenced by both the COVID pandemic and the sort of aftermath of that on the construction industry in terms of supply chain issues, but we continue to work. Our OFP team does to expedite these projects. And as I mentioned, we'll talk a little bit more about how we track cash flow projections with them in January. Also note, we have submitted a drawdown for an additional $15 million as of this morning, so that should be received shortly. The next page, again, provides an overview related to that new money of how it's been budgeted to use. We give you both a breakdown between equipment and infrastructure, bulk of it, 75% roughly, being for infrastructure. And we also provided the spread across facilities, which I know many of you are interested in. This particular funding being tied to the refunding that we were doing in 2020, we had a goal for the specific kind of target average life of the projects that this money would be used for. So that kind of heavily informed some of the things that were selected to be used with this funding, as well as the expectation at the time that projects, could proceed expeditiously. So this, represents a small portion of our capital program, but we did want to provide this distribution by facility because we know board members are interested. The next page, I won't go into detail, but it does provide some significant amount of detail on the spending status with respect to these projects. You can see that as of June of this year, we had spent a total of roughly $29 million, and we project that nearly all of the funds, about $98 million, will be spent by the end of this fiscal year. And we'll provide more detail again in January on the status.
Did you say that you expect it to be spent by the end of next fiscal year?
By the end of this fiscal year, so June of 2023, we are projecting roughly $98 million to be spent.
Thank you.
So in addition to our bond program, the board has authorized the system to borrow up to $120 million for equipment financing, or to have that balance outstanding at any time. So we wanted to provide the activity that occurred over the reporting period. We had 3 loans active during that period, and we closed June having paid off 1 and a remaining balance of $59 million, or 59.5 across the other 2, and we'll go into the status of those on the subsequent pages. The first loan being the Citibank loan that was issued in 2017. It was a 2-tier loan, a fixed rate component at $30 million with a 5-year term. That matured November 1st of this year and had an interest rate of 2.17%. And there was also a 30-year revolving loan. That was a 5-year term with a variable rate that matures in October of next year. Moving on. The next piece under this is we had a JP Morgan loan that we closed during this reporting period that was to refinance some existing borrowing that we had with NYPA, the New York Power Authority, which was for boiler projects that took place at Elmhurst and Metropolitan Hospitals. We had initially closed those loans with the expectation that we would have long-term variable rate financing through NYPA, but their policy changed and they began to phase out their variable rate loans to their clients. They were seeking to offer a syndicate type of loan. We determined that we would be better off to refinance these on our own, so we issued an RFP for a direct placement loan. And a result of that RFP, we closed in June of this year on $39.75 million loan to fully refund the NIPA debt. And that has a 15-year term, fixed rate of 2.6436%, and matures in June of 2037. So we were happy that we were able to execute that in the timing that we did. And we also issued a rate lock earlier in the year that protected us somewhat on that interest rate. So on the last page, as I said before, we just wanted to touch briefly on a market update. As I'm sure everyone is aware, the Federal Reserve Bank began to raise interest rates significantly starting in March of 2022 to address ongoing inflation. So total increases since that time have been 3.75%. So, and this, so speaks to the risks and reward of variable rate debt. In the environment that we've been in. So over the past, several years, the system's benefited very significantly from very low interest rates on our variable rate debt portfolio, which is, a relatively small portion of our debt program, but we think it's provided important savings, as I mentioned earlier, for our bonds. We think $72 million over the life of those bonds to date. But we are now starting to see higher interest rates on that debt. So as of November 9th, the variable rate bonds reset at 2.14% to 2.16%. And our Citibank variable rate was reset to 2.79% at the same time. So we are starting to see those increases now. We think overall, it's still been a good move to be in the variable rate debt. And we also note that our investments, both on our bond proceeds as well as our other operating cash, has benefited now from this higher interest rate environment. So we are seeing higher rates on T-bills, which is our primary investment. And we'll talk about that as we get into cash flow in January also. So that concludes our presentation. I'm happy to take any questions.
Thank you. I'll open it up. Benioski?
Thank you for the presentation and for the information. I thought that we had a discussion in another setting about these issues of the interest rate, but I don't remember all the details. Are there mechanisms that we could have fix the rates? And I thought that for some loans we did have a fixed rate, but I just want to know if there is something that we have been looking at in order to avoid any other issue, moving forward. I know that, and maybe Frida knows definitely more than me on that, but a lot of people saying that 2023 is not going to be any better than 2022 in terms of the financial and the interest. So,
Right. We can evaluate. We do always evaluate, and we receive proposals from our financial advisor as well as the various banks that we work with regarding refunding opportunities, which would be how we would fix out any of those loans. I know when we looked at these, when we did the 2020, it did not appear to be advantageous for the.
Yeah, the 2008 bonds have it's been time has passed for so long, and the asset life remaining has been shortened. So from that point of view, it's not advantageous to fix. Yeah. And we have successfully fixed out the NIPA variable rate loan to a fix at that 2.4% before the rate get up really high. Yeah. Taken some risk off the table.
okay.
Right. And so, the bulk of our variable rate loan matures fairly quickly. We have some of those bonds which will extend for a few more years, but as Pauline noted, the life on the assets makes refunding difficult.
Very difficult. Okay. And how do you see the outlook in terms of the exposure with the variable versus the fixed? Is there any strategy to de-risk some of those loans or no?
I think historically variable rate has, even though if it spike up, it's a short period of time it will come down. So historically, it has been advantageous to have variable rate exposure, although you wanted to be able to manage it. So we manage it by having exposure around the 20%.
Oh, okay.
So our, as long as our cash flow could handle the spike, it should be fine.
Okay.
Yeah.
Because if you fix it, if it were an opportunity even to fix it, you're fixing it at a higher rate.
Correct.
So then you're sort of gambling, right, that the variable will continue to go higher than that fixed or not come down.
Thank you. And I really appreciate you sharing that around the threshold for the risk tolerance around the
About
20%.
20.
And that,
20
I
to
think,
25.
Yeah, around that. I
Okay.
believe the city probably also have a variable rate exposure in that percentage as well.
Thank you.
Thank you, Penny. And I just echo, and I think they pulled up the chart here. You can see the orange line is the variable rate, and that's the, it's been very, very low for a long time. So I think that you don't want to ignore that aspect of the savings, and having the, 25% is okay, is manageable. And the fixed rates in terms of what you guys have done, I thought was great in converting that NIPA loan to a fixed rate prior to rates really spiking up and getting a 15-year. I think I noted that your current variable rates are higher than the 15-year fixed rate. So having done that was very opportunistic. So that was a nice management of that transition for that loan. Any other questions? Sally?
Just from an overview perspective, is it safe to say that we have invested the funds, the proceeds, in a time frame consistent with what the outside time frame was within the different bond issuances? Are we confident that we're going to be able to invest within the time frames?
You mean in terms of having the funds be available for expected use?
And being used within a certain time, or they don't have to be used within a certain time?
Are you speaking of spend down, Sally?
Yeah.
Just to make sure that we spend it.
Yeah, so the investment policies, which we started talking, actually we reached out to our controller's office as we were putting this together to get a little more information about it. So we're still putting together information that we'll bring in January. But our investment policies are fairly conservative. There are some directions in our authorizing statute about limitations on some of our investments. So T-bills, government tends to be the predominant choice, but they are, sort of managing with an understanding of our need for spending, and we've never had an issue with funds being available with respect to investments.
Okay, thank you.
Any other questions? Phineas?
Sorry, I have mouthful. Looking toward the future, and I know that from the capital perspective, there is a lot of interest in investing in a lot of the facilities, and I think there is a request from the city to the city to get more fund. Do you see us going more to the financial market to fund some of those capital? Again, maybe Dr. Katz may have to help with that answer, but when you're looking at the future, are we expecting to go more to in the coming year?
I don't think we're anticipating any significant change in the balance between how we use our funds and how we use city funds. It's generally always our preference from a financial perspective to use city capital. And we're also, there are some more significant opportunities for both state and federal capital investment that we'll be pursuing. Deb's office is working, looking at that as well. So I think we don't, I don't think our borrowing is the type of investment that we need to make, but it certainly will continue to be a key component.
But there is no plan right now to go to the bond market again in 2023?
No.
Okay. Thank you. Thank you.
Any other questions? Okay, great. Thank you very much for the report. And it's, I think we're managing well despite the rising interest rates and not needing to access the market now. So very nice job on the portfolio. I think if that's it, is there any old or new business to come before the board? So if there's no further business, I declare this meeting adjourned.
You're here.
Thank you, everybody, for
This meeting is no longer being recorded.